It is once again time for our weekly market review where we analyze the stock market to see if a correction or crash is coming. And if you're thinking about commenting below like, oh AK, you're calling for a crash again just like you have been doing for the last 6 months, well, you might just be an idiot. Because if you actually watch these videos, you know we've been bullish for a very long time. So clearly you haven't actually watched any of the videos. And if you're complaining about the fact that the title of this video is asking whether a market crash is coming, well, the reason I title all these videos the same way is because people only click on market crash. Is that my fault? No, I don't think so. You gotta give the people what they want to click on. And I know people love these market crash videos because I see the analytics. So if you yourself believe that risk management in the market is important and protecting your money is important, then you are in the right place, because that really is the key to building your wealth for the long term in the stock market. That's why we focus so hard on risk management and protecting your downside in all these videos. Now, if you don't think that's important, then you might as well click off right now. Now that I've said all this unnecessary stuff, let's get into the video. So as usual, we're gonna go over the general markets to analyze what's going on to see if a crash or correction is coming, again, to protect our downside. Then we got a stock for you too that we're looking at that you may want to add to your watch list. And we'll finish up with a really important lesson from a legendary hedge fund manager like we normally do. We're always trying to improve our game here. As usual, we will be going over our research from MacroOps, our global macro research and consulting firm. This is our weekly Dirty Dozen, the review we do every single week. First up, Ray Dalio, who you all know, he published a short piece last week where he compares the Biden administration, as well as today's economic environment, to FDR and those of the 30s. And you know Dalio's view because we've covered it extensively on this channel, but he believes that we're at the end of another long-term debt cycle, just like we were back in the 30s, or I guess 20s, but during that whole time period with World War I and World War II, which is, of course, kind of scary because what does that mean? That another war is coming? That global powers are shifting? Yes, probably, but let's hope that doesn't play out. So as you can see here, there's a number of similarities. In both periods, we hit 0% on the short-term interest rates, and this is back then compared to now. You can see that long rates also got close to zero here. They're both dropping. And money printing substantially picked up. You see our money supply shooting up like crazy. So there are no doubt a number of similarities as well as differences, but one thing is clear. We are definitely moving back into an era of big government. Now, in some ways, this is good, and in some ways, it's bad. So one thing that we know that we've talked about on this channel is when government gets involved and they start using their fiscal stimulus, that's always great for the stock market. So Biden's enormous infrastructure plan, that's actually good for the country because we could get a lot of capital intensive projects underway, which we've needed for a long time, and you create jobs and you boost the economy. And hopefully all that stuff goes towards productive projects. Of course, there's going to be a lot of waste in there like there always is, but overall, yes, an infrastructure plan looks good. One potentially bad thing about a bigger government, and this is controversial, like you could debate it either way, is that people get too reliant on it. So I've talked to a lot of small business owners and they're saying that it's tough to hire right now because people just don't want to work. Now here's where the argument comes in. A lot of people believe that unemployment benefits are too nice right now, which is causing people to say, hey, why should I work? Let me just collect this money. And that's why they're not going to work, and that's why it's tough to hire. Now on the other side, you could say, hey, you know, people need this money and this is great, which is partially true too. When it comes to this stuff, it's not black and white. It's just gray all over the place. Now you can comment down below with your opinion, but I always wonder about that universal basic income. If you took away unemployment and all these things and everyone just got an extra $1,000 a month or whatever, would that just be better? Then there's no unequal benefit of not working and getting free money because everyone's getting that money, but any work you do will just add to that level. So maybe it's a good idea. I don't know. Comment down below. Moving forward, Bank of America notes that the acceleration in buybacks and stock inflows should be greater than the annualized new supply of shares. And this here goes back to supply and demand, which we tend to forget because the stock market is so complicated, but honestly, everything goes back to supply and demand, Econ 101. So for a stock price to move up, what needs to happen? There needs to be less supply than there is demand. So all the bidders will push the stock price higher, and that's how you get higher stock prices. Now that same idea works for the market in total. So if you have an acceleration in buybacks, meaning more demand, and stock inflows, again, more demand, and if that is greater than the annualized new supply of shares, which is supply, right? Then the stock market will be pushed higher. Now you want to see something really interesting? It's crazy what happens when you do the math. So here's another article from MacroOps describing the supply and demand in the market. So historically, US corporate share issuance has rarely exceeded 2%, meaning the amount of shares in the market of different stocks is not growing more than 2% a year. But over the last 3.5 decades, corporates have actually been reducing their share count through buybacks and M&A. And that's been happening at an average annual rate of 2%. So that's another thing to realize about buybacks, that it's demand, but also when it happens, it reduces supply, right? Because these companies are buying back their own shares and then no one else can buy them. But to make this simple, let's just say from a supply perspective, supply is going down by 2%. Now, over the last 50 years, the money stock in the US has gone up at an average annual rate of 8% a year. And we're talking about money stock as in how much money is floating around in the economy. Because the truth is, when you have more money in the economy, people are going to have more money to buy things, including financial assets. So we talk about how the Federal Reserve determines the market, right? Because they determine liquidity conditions. So if liquidity conditions are easy, there's more money flowing around, and that money is going to go push up financial assets. Same reason if they increase interest rates and make things tougher, you'll see the stock market take a dip too. Less money floating around. So the money stock in the US has gone up at an average annual rate of 8% a year. So over the last 5 decades, the supply of equity, the available shares, has been dropping at an average rate of 1 to 2% a year, while total money stock has gone up at an average rate of 8% a year. So if we do the math, we get a structural supply deficit of approximately 9.5% a year. So when you combine the decrease in shares and the increase in money, this is the mismatch you're getting per year. And you know what the average annual return of the stock market has been over this period? 9.5%. That's the average annual return of the S&P 500 over the last 50 years. The same percentage as the mismatch in supply and demand. Crazy how that works out, right? But that's why the equity supply and demand equation is critically important to watch. So all in all, if we're getting more buybacks and stock inflows, and it's more than the annualized new supply of shares, that is bullish for our stock market. Financial conditions are currently the loosest that they've ever been. So it's very easy for companies to borrow money to buy back their own shares. You can see easiest US financial conditions on record. So that's what we were talking about before, the Fed making it really easy so a lot of money flows around in the economy, which includes companies being able to borrow money for cheap and buy back their stock. The end of April has brought us new monthly charts to look at. And you know, we always keep track of monthly charts of these indices, like the S&P 500, NASDAQ, because when you zoom out to the monthly level, it's easier to distinguish signal from noise. The further out you go in time frame, the better signal you're going to get. If you're looking at daily charts, you know there's false breakouts and false moves all the time. It's almost like random. More you zoom out though and look at the larger trend, that's going to be a much better signal for what's going on. So every month we're looking at the new bar that printed and analyzing what it means. So you can see here that April was this bar right here, and it's a very big bull bar. So because this bar was so bullish, it means that we should get further action to the upside, meaning the market will keep going in this direction. But the fact that April's return was over 5%, which is uncharacteristically large for the stock market, means that we're entering that FOMO climactic buying. See, things are getting stretched and we're firmly in the climactic phase of the buy climax. And remember, we've been talking about this for a long time now. Our current theory is that the stock market was entering a buy climax, which means things shoot up really fast. And I mean, that's pretty much what we've seen, right? Look at this chart. Incredible. Now, what happens with the buy climax is that things pop off really hard, but then they hit that correction. And after the correction, they go sideways for a very long time. So we're in for way more volatile markets after this buy climax plays out. But the thing about buy climaxes is that you don't know actually how long they're going to play out for, which is why you should never try to short it or anything like that. You'll likely be blown out. So again, we're still bullish on the market because this buy climax is still playing out, but with how positive this month has been, it looks like we're in the climactic phase of this buy climax, meaning we're at the end of it instead of the beginning. Now, do we know any of this stuff for sure? Of course not. We're analyzing and weighing the probabilities here. No one can actually predict the stock market. And the thing is, you don't need to be successful and make money. And we'll talk about that more in a second here. But yeah, still bullish for now with the expectation that things will turn around because the trend is becoming more and more fragile as this buy climax plays out. So I'm sure none of the people that usually comment in the comment section about, hey, you're so bearish all the time, you probably haven't made it to this point. But if you did, congratulations. And now you see that we are still bullish. Now let's go over one area that we're looking at in the market and a particular stock you may want to add to your watch list. The area we're looking at is cannabis stocks. They're making a comeback right now. Can't wait to see all the YouTube videos about it. Oh boy. But we're interested in US multi-state operators with a lock on their regional markets. The ETF MSOS is a great play for this because its heaviest weighted names meet the above criteria that we're talking about. The fundamentals are increasingly bullish for this industry and the technicals are starting to line up. So if you want an easy way to play this rebound, then definitely check out this ETF. But if you're going to play this stock or any stock, there is something important that you need to know. Something that Jim Paul right here described in his book, What I Learned Losing $1 Million. And he's a famous money manager. He said, remember, you don't get any money just because you know why the market is going up or down. You only get money if your plan has positioned you to capitalize on the market's movement, regardless of whether you know why the market is up or down on a particular day. So this is a really important point that Jim Paul is making. What he's basically saying is that the most important part about actually being successful in the stock market comes down to your strategy. Because like I said before, no one actually knows what's going to happen in the stock market. We do all this analysis, but at the end of the day, we're just weighing probabilities and we very well could be wrong. But it honestly doesn't matter how often we're wrong or right because we have strategies in place that are going to capitalize either way. When the market market moves against us, we manage our risk. Again, we always talk about risk management, right? When the market moves for us, we make sure that we're in the right bets so that they take off. And honestly, when you have the right strategy in place, you really don't have to worry so much about analyzing the market and getting it right every time. Now, in our Fallible strategy, that's even more true because we are fully systematized. So everything is automatic based off an algorithm. You see right here, our algorithm measures each stock in the NASDAQ by its momentum, and it spits out a TSI number. So we can see which stocks have the most momentum. Then every month, we're just rotating into those stocks. So there's no real analysis required because it's all done beforehand in building the system itself. So we basically do what Jim Paul is talking about here. Our plan or our strategy system, whatever you want to call it, it has us positioned to capitalize on the market's movement regardless of whether we know why the market is up or down on a particular day. The stock market can get super complicated, so our job really is to simplify it. And through that simplification, you can make a lot of money. So myself and all our Fallible members, we don't even have to look at the market because the model just spits out alerts that come to our phone and email, and then we make a move based off that. That's the power of having a systematized strategy. And the stress level, way down, because you don't have to worry about trying to predict the market. And as always, if you want to learn step by step what our strategy is so you can use it yourself, definitely check out our free training. We go over the whole thing, same thing I myself and all our Fallible members use. I'll put a link to it in this video and down below in the description and comments. It is so important to have the right strategy, especially as we go into more volatile markets after this buy climax. So if you want to check out our strategy, click this link right here and it'll take you to the training where we'll teach you how to do it. So click here and I will see you in that training.